All right. Hello, everybody. Welcome to the Tuesday night Hurley INvestments webinar. Of course, as always, I want to make sure everybody's hearing me. And if I am being heard, go ahead and type in a yes into the chat. Alrighty, Bill, thank you. Anybody else? Can you all hear me? Ida, Abraham, Maud, give me a quick yes if you would. Perfect. Thank you guys so much. All right, obviously, I am not Kevin. I am taking over for the webinar tonight for Kevin. He's got a daughter with a birthday today, and he wanted to spend some time with her and obviously family. So, I kind of struggled. Oh, by the way, my name is Keve Bybee. I've taken over a couple times. I'm sure some of you recognize my name. To be honest, I kind of struggled tonight to figure out what to talk about. It's kind of an interesting period in the year. Obviously, we have some significant headline news of Turkey. Turkey's problems. A couple of the things I'm sure you've heard of is our wonderful President Trump tweeting about raising tariffs on steel and aluminum on Turkey. A few other problems are their debt, and of course their Turkey lira is their dollar is weakening against our strong dollar, and they have runaway inflation problems, and their president refuses to rise interest rates as he has pretty much total control over their central bank and has prevented them from raising interest rates to curb some of their inflation. Obviously, when I could kind of see what he's thinking, obviously they've got so much debt that raising rates on such high interest on debt is going to be tough for them. Not a lot of good options, but obviously any sound economic theory would tell you that he's kind of stuck with having to raise interest rates. Anywhere else in the world, they would obviously do that. We're doing it. That's kind of our thing right now with our rising inflation. We're trying to curb that by rising interest rates to keep that around 2%. Alrighty, so I guess what I want to talk about is some of the exposure we have as far as U.S. banks to Turkey. What is it, if anyone can help me out, what is it that could pose a problem for our banks with regard to the situation in Turkey? obviously our first concern is how much those banks have an exposure to sovereign debt of Turkey. As I've gone through and done a little research, Contagion, thanks, Mod. Yes. So part of that is direct exposure to Turkey, as I've done some research. There isn't a ton of exposure. When you read of articles talking in billions of dollars and all that, it seems crazy, but percentage-wise, pretty little exposure. What I think, obviously, the greater concern would be is some of our bank's exposure to Europe. Why would that be? Odd says the debt won't be paid. Yes. So to think of it this way, banks lending to companies in Turkey, Turkish companies make their money in lira, and then they're having to pay back loans to international banks such as BBVA is the biggest one. So I specifically named that. Italy had some, their big banks have a larger exposure too than many other countries. But obviously that proposes a problem because, if you're making money in one currency and having to pay it back in a different currency that's doing better than the one that you make money on, that makes it much more tough to pay your debts. I'll say tough for companies. Let's say companies in Turkey to pay debt. I'll say in dollar and euro. So the good news is I have a lot of people invested in Bank of America. They are probably, out of those three anyway, the least exposed directly to Turkey. But certainly it does give me some concern with how much some of these banks have exposure to Europe in general, because they're the next closest in exposure directly to Turkey. So kind of a third, in way of a third party exposure, I guess. But the good news is Bank of America and many of the other U.S. banks make their money on U.S. Treasury yields for the most part. So let me just look at a chart Bank of America real quick. This has been a tricky one, and it's kind of been tricky for the rest of the financial sector. Unfortunately, I've talked about this several times. You can see the last few days as that news has come out. Friday, Monday, Bank of America has come down from a really big rally from earnings, rally into earnings, I guess. It would be interesting. It'll be interesting to see the next few weeks, the next few days more, on where Bank of America ends up. We kind of expected at this point to see it test again the 200-day, but today we've seen a nice bounce right at $30.50. But this one, I don't know. I've got a little bit of a different position from it, from what I'm managing versus what Kevin's managing. And I put protection on yesterday, expecting it to go test that 200-day moving average right here in the next few days. So Kevin has not done that. So if it goes down and tests that, I'll look like a genius. If it goes back up, Kevin will look like a genius. And you'll know who to make fun of next week. But yeah, any questions on specifically that? Do you guys have any investments in Bank of America? Have you avoided this one? I'd love to hear from you any questions on it. All right, I got a question from Ida. Other than protective puts, what method do you use for hedging? How does a retail investor recognize the signs of the upcoming crash that a number of research firms and CFAs predict more frequently now? Well, I'll tell you, Ida, that no matter how much research power and any of that the big firms have and institutional money has, they still cannot predict the future, believe it or not. So it might not be, obviously that they do have some advantage there, but it might not be quite as much as you might think. So what other options other than protective puts of methods used to hedge? That's a good question. Let's put that to some of the other listeners. What other hedging methods would you use? Doesn't necessarily have to be for Bank of America, but what other hedging methods might you use on some of your stock positions? Help Ida out. Anybody, come on, guys. I know you know some answers. All right, Mod, inverse ETFs, indexes. Okay, those are some options. Inverse ETFs. Do you remember what happened to inverse ETFs back in February? I won't go into it now, but a lot of those have been closed down, especially the 2x, 3x time inverse ETFs and XIVs and some of those other ones, because they basically crashed. So there are some options there, but not one that I would use. Thanks, Mod. Yeah. Yes, I don't use them, but just an answer. You're right. Abraham asks on volatility, a hedge on volatility. Is that, I'm guessing, what you're asking? Maybe expand on what you mean, Abraham. Mod says a put spread. Yeah. And I'm guessing what you mean on that is a bear put spread to make up some money, a limited amount of money onto the downside and lower your cost basis on that long put. Perfect. And I'll expound on that in a minute. Abraham says using volatility as a means to hedge indicator. Well, let's look at volatility. That's kind of a tough one. Look at these days. This day. I think if we went out to a year, we'd see February. Kind of tough to use volatility as an indicator, but I would say when volatility does kick up, we've talked about this multiple times. I know Kevin has talked about it an awful lot, but on those days of big drops in the market, volatility ramps up. And what happens the next day is we have what's called volatility crush. And the price on options goes down significantly. So if you're going out and buying protective puts on a big down day where volatility kicks up, like on February 5th, the next day you could lose half the value in your puts, just overpaying for them. So excuse me, just reading through some more comments here. All right, so Abraham, maybe what you're maybe thinking of, and to go back with what Maud was talking about, excuse me, to go back with what Ida was asking about. Another way to hedge is, and we've talked about it, is short calls. Obviously, if you have 100 shares on let's talk about a covered call position on SPY. If you have adding short calls on a big down day is going to be much more useful to you than just buying puts. Because selling options is going to benefit you on those big down days when the volatility crush happens and they lose value the next day. short options losing value is good for the seller. Does that make any sense, Ida? So let me just go back to Bank of America. And tell you exactly what I did. Let's go back to 6 months to get a little closer. So yes, I did buy protective puts because I feel as though Bank of America is going to come back and test this with everything we've gone over, with the news of Turkey, the European banks, yada yada. So I bought protective puts, but I also, to lessen my cost basis, I also sold calls. Sold short calls up at 32. Bank of America has had a tough time getting above 32 for the entire year, just barely getting close back in last week. So 32 short calls, we're obligated to deliver our stock at 32 if it all of a sudden goes up. It's a good bet because obviously we haven't gotten above 32. Out to September, that gives us some good, it wasn't a ton of credit, it was like 1% of the value of the stock, like I think even less, like 21 cents or so is all I got. It cost about $1 to protect with protective puts. So I did lessen my cost basis a little bit. And my plan is if we get down lower, or even if tomorrow this bounce looks like it's going to hold and continue to go back up, my plan is to sell 30 short puts against my long puts at 31, which goes back to what Maud was suggesting. I'll get to your question again in a minute, Maud, but you were suggesting earlier put spreads, right? So I'm kind of trying to time it a little better. I want to wait to confirm that this is a good bounce that will reverse tomorrow. If it doesn't, obviously I'm set to make up some of that downward movement. If it goes down, hits 30, I'm looking to see it hold that price and bounce up from there and sell short puts against my long puts. And I'll kind of have this price range of 32 and 30, where I'll hope to at least pay off most of that protection, and at least be protected down from 31 down to 30. So Maud asks, so what would you do if it did go past 32? Let the stock go up or buy back the call? It kind of depends. I know that's probably not the answer you want immediately, but it depends on why it's going up. I would probably wait to see it hold above 32 for a few days. I could buy those back for a loss. That's an option. I could, for a loss, at least on the short calls, to not be obligated to deliver stock. So obviously, I'll be honest, I don't want to be obligated to deliver, or excuse me, I don't want to get rid of that stock at 32. I want to see it go up higher, especially with this year of it kind of sentimentally trading low on all of these headline newses such as Turkey and those things, even though fundamentally making so much good money as a bank, I definitely don't want to get rid of it. But I do have the benefit of actually holding some long calls already. So if I do get called away all of a sudden, I'm not out of the game. I still have long calls that will go into more value as it obviously goes up. So, but what I would look to do to answer your question is I would probably just buy them back, roll them out and roll them up to maybe 33 or 35. But, obviously all that depends on why it's going up. And obviously if it holds above 32, I'm kind of a wait and see sort of guy. And, this is only out till September. I kind of don't think it's going to get above 32 through September. So, yeah, great questions. Thank you for the input and questions. Any other questions on this in particular? Not necessarily Bank of America. Any questions on our turkey situation? So here's another little infographic. Emerging markets in general are getting pretty hammered. Most notably Turkey, down 50% for the year. Brazil, Argentina, their economies are all doing pretty poor, have a lot of debt. But I was kind of surprised to find out how many were doing so poor. So my hope, and you can tell me what you think, but my hope is that this drives money into the U.S. and into U.S. treasuries to kind of turn the attention towards banks making money with the treasury yields, because our financials have really gotten hammered this year, and it really has not followed what you'd think it'd follow for the fundamentals and how banks make their money. It's kind of a weird situation. So who knows? Maybe this will be good for U.S. treasuries and hopefully in turn U.S. banks. But it might come down to our last quarter of the year. We have, as we've talked about a lot of U.S. debt that has to be rolled over here comes fall, and we have elections, and there's a lot of things coming up that will likely push the market back down to test key support levels before it heads back up to rally for Christmas as it usually does. So where will our markets end this week? Put higher. Just to take a peek at some of the charts. Dow Jones Industrial looking like it's bouncing right on. Right on 25,200. But obviously you can see how it's been affected as well. All of the indexes from the latest trade news and trade fears. But I do think at least this week we'll see it bounce. Maybe it will go back up and test. But obviously, if we get a double top here, as opposed to a double bottom here and here, that's pretty bearish. Let's see. S&P looking much better than the Dow. Anyone see this line? I'm kind of expecting myself to see at some point it come back and test the 50 blue line here. But whether that's this week, I don't know. Kind of feel like some of the headline news has subsided, at least for today. And could test up back up at 2,800. NASDAQ also having trouble getting above 7,900 is the number. And it's a little closer to the 50-day. But I suspect at some point, probably next week, we're going to be looking at testing this at some point on every one of these indexes. Oops. All right, here's our pointer. Where will we end August? Down 1%. That comes with obviously my thinking of testing our 50 days on all of our indexes here. There's still room. You see the Dow bouncing up right at a support level, 25,200. So it's kind of in that range where a few of them are actually coming down to a small support level to test. So maybe that's partly why we're seeing it bounce up from there. But I think a little further out, we're looking at coming back at some point to test 200 before going, or excuse me, the 50-day before heading up. We do have some earnings that could work in the favor. We have Cisco's a big one Wednesday. At Hurley Davidson today. I don't know how that turned out. Is anybody trading Hurley Davidson by chance? Recently, news on Hurley Davidson is looking to move manufacturing out. They have a lot of manufacturing, in India. That tariffs are going to be hurting them. They're according to them, and they're deciding that they're going to start moving manufacturing elsewhere as a result. JCPenney Thursday, Walmart, Nvidia. So I think we're kind of getting closer to the tail end of earnings, but there are a few that could help us out towards the end of August. Though I think we are in line for down 1%. What do you guys think? Am I crazy? Maud says, same. Well, thank you, Maud. I do think that our headline news on Turkey isn't over with yet, but seems like we'll get a tweet or two, and the market will come down for a few days and get fixated on something else. Maybe this week will be the Cisco's and the Nvidias, but generally through the month of August, I suspect that we'll be on the downside of flat because we've rallied so far already. Anyways, rambling on. There are a few lists of econ reports. The one I'm going to be most concerned about isn't necessarily an economic report, but options expiration coming this Friday. That's an important day. Sitting down, looking at all of my positions, going through and adjusting things if I need to go further out on puts, if I need to let things expire. That's kind of an important day, but more important as I have some short positions out in to August 31st, weekly options. So that might be a little more important than the monthly options expiring. But it is a day to kind of sit down and take a look at things anyway. Alrighty, well, thank you for listening to me ramble. Yeah, it was kind of a tough to figure out what to talk about, to be honest. But I hope I've at least given you something to think about. Articles I've listed here, not listed, but attached. We'll have one going over Disney's quarterly profit. And that one's been kind of interesting. Just take a look real quick. I'm protected on Disney. I've rolled puts from 110 all the way up to 115. And those are coming profitable nicely. But it's surprisingly holding 112. I would suspect that a better support level would be 110, but fundamentally speaking, it's kind of interesting because it seems like every investor is more concerned about ESPN than they really have reason to, and ESPN continues to lose subscribers, and that has usually been a pretty big reason for Disney to go down. But I think with the other story is helping at least to establish a base at 112 is because of the $71 billion purchase of 21st Century Fox. The reason being is because Disney does pretty good with the how they monetize brands and franchises, specifically in this case Avatar, Simpsons. There's some other ones, and they opted out of purchasing Sky Sports out in England. I kind of would have thought that would be an excellent purchase for them to kind of boost ESPN, but I think investors at this point are happy with Disney going out and putting more of their investment where they know they're good at, which is these types of purchases franchises rather than networks, because they've not fared so well on the ESPN networks and such. So that's a good one to read. Warren Buffett predicting a market crash. This one just goes over the amount of cash holdings that Berkshire Hathaway has and how they tend to be up at the top of markets, have more cash holdings. Obviously, when you have as much money as Mr. Buffett has, you're selling when it's up high and you're buying back in when you have all that cash and goes down, you're buying back when it goes lower. So I don't necessarily think that this is a good indicator in as far as really good timing on the top of the market, but it is yet another piece of information that's telling us we're probably getting close to our top here. So I'll obviously attach those in the for the website tomorrow. Any questions right now before we wrap up? Are there some things you guys are worried about? Any specific stocks you want me to look at? I'll probably let Kevin go over Baidu. This is going to be an interesting one. I'd love to hear what Kevin talks about maybe next Tuesday. Baidu coming all the way back down to 215. That's going to be fun to hear about. I know Kevin's made up a lot of that downward movement, so that'll be interesting. Anyways, I'll go ahead and wrap it up. Thank you guys for coming out and listening. CRM Tiva. Ida asks about CRM Salesforce. Looks like it's going to be testing a top at 147. I don't know too much about this stock, but you're probably asking because Buffett has upped his stake in these pharmaceutical. Technically, we're looking at a double bottom here, and we'll probably go back and test the 50-day, but it's kind of in no man's land right now. And similarly, I guess oppositely, CRM is going to be testing its top and probably testing, if it's not going to make that, testing back the 50-day. But I don't know enough specifically about those companies, Ida, to give you anything really important to say, but looking at technicals, I would keep those in your back pocket, throw them at Kevin next week. And if there are any other questions, I'll wait a second. But otherwise, thanks you guys. I really appreciate it. It's kind of weird for me to feel like I'm talking to myself. It's a very weird experience, talking without people talking back at you. Thanks, Ida. I appreciate it. All right. Appreciate it, guys. Is there any other questions coming in? I'll see them. If not, otherwise, we'll talk to you guys next week. And thanks for joining me.